The accounting cycle is the procedural heart of financial reporting. It begins with the systematic capture of financial events, a process that is not arbitrary, but a structured discipline governed by a framework of internationally accepted standards. This framework is the ultimate source of trust for stakeholders, ensuring that the financial data presented is captured with accuracy, traceability, and consistency. This data forms the bedrock of all subsequent financial analysis, capital allocation decisions, and corporate governance. In this session, we will dissect the mechanics of recording transactions, from the high-level governing principles to the final balancing of individual accounts. Before we examine the how, we must understand the why. Accounting practices are governed by high-level standards to ensure comparability and reliability. The two primary sets are IFRS and GAAP. International Financial Reporting Standards, or IFRS, are issued by the International Accounting Standards Board, IASB, and are used in over 140 jurisdictions, including India via its converged IND-AS. Their goal is global harmonization, allowing an investor in Mumbai to confidently compare a company in Germany to one in South Africa on a like-for-like basis. In contrast, generally accepted accounting principles, or GAAP, refer to the standards used within the United States, set by the Financial Accounting Standards Board, FASB, and enforced by the Securities and Exchange Commission, SEC. US GAAP is known for being more rules-based, providing voluminous, detailed guidance for specific scenarios, whereas IFRS is more principles-based, offering a broader framework that requires more professional judgment. For example, IFRS has one overarching standard for revenue recognition, while GAAP has numerous industry-specific rules. Adherence to one of these frameworks is mandatory for public companies and lends critical credibility to their financial statements. The foundational layer of the recording process is bookkeeping. It is the methodical, day-to-day recording of all financial transactions. In India, this has evolved dramatically. The traditional manual Bahi Khata, or ledger book, served small businesses for centuries. However, as businesses scaled, the need for efficiency and control led to computerized systems like Tally, and ultimately to integrated enterprise resource planning, or ERP, systems like SAP and Oracle in large corporations. In an ERP environment, bookkeeping is the automated outcome of every business process. A sales order automatically updates accounts receivable, inventory, and revenue, shifting the accountant's role from data entry to data analysis and exception handling. The scientific core of modern bookkeeping is the double entry system. This system is built on the premise that every transaction has a dual aspect, maintaining the fundamental accounting equation: assets equal sign liabilities plus capital. For example, a new business starts with a RS5 00000 owner investment. The business's cash, an asset, increases by RS5 00000, and its capital equity also increases by RS5 00000. Then it buys machinery for RS1 00000 cash. One asset, machinery, increases while another asset, cash, decreases. The equation remains perfectly in balance at every step. The advantages of this system are profound. It ensures a scientific and systematic recording of all transactions. The inherent equality of debits and credits allows for the verification of arithmetical accuracy through a trial balance. It facilitates the detection of errors and frauds, as any attempt to create a one-sided entry or manipulate a single account would throw the entire system out of balance. It provides a complete audit trail and is indispensable for preparing reliable financial statements, enhancing credibility with all stakeholders. To implement the double entry system, transactions are classified into accounts. There are three primary types. First, personal accounts, which track transactions with individuals and legal entities. The golden rule is debit the receiver, credit the giver. For example, if we sell goods on credit to Mr. Sharma, he is the receiver of the benefit, the goods. Therefore, Mr. Sharma's account is debited. Second, real accounts, which pertain to the assets of the business. These can be tangible assets like machinery and cash, or intangible assets like patents and goodwill. The golden rule for real accounts is debit what comes in, credit what goes out. If the business purchases machinery for cash, machinery is coming into the business, so the machinery account is debited. Cash is going out, so the cash account is credited. Third, nominal accounts. These are temporary accounts used to track financial performance. They include all expenses, losses, incomes, and gains. The golden rule is debit all expenses and losses, credit all incomes and gains. When the business pays salaries, the salaries account represents an expense, so it is debited. When it earns sales revenue, that represents an income, so the sales account is credited. The first place a transaction is formally recorded is in the books of original entry, also known as the journal. The journal is the financial diary of the business. For efficiency, it is often subdivided into subsidiary books for high-volume transactions such as the cash book, purchases book, and sales book. Transactions that don't fit elsewhere, like the purchase of an asset on credit, depreciation entries, or rectification of errors, are recorded in the journal proper. This segregation of duties also provides better internal control. After being recorded in the journal, transactions are classified and summarized in the ledger, the principal book of accounts. If the journal is the chronological story, the ledger is its analytical index. It abandons the timeline to group all transactions related to a specific account in one place. A manager cannot easily determine the total amount owed by a single customer from the journal, but the ledger provides this information instantly by presenting the customer's account with all its debits and credits consolidated. The process of transferring entries from the journal to the ledger is called posting. It is a mechanical process where the debit item in a journal entry is posted to the debit side of its respective ledger account, and the credit item is posted to the credit side of its account. The journal folio, or JF column, in the ledger records the page number of the journal, creating a crucial cross-reference that forms a clear audit trail. The cash book is unique as a journalized ledger, requiring only a single posting for each transaction to the corresponding account. The final step in the ledger process is balancing. This involves totaling the debit and credit sides of an account to find the difference, known as the closing balance. For instance, if a cash account has total debits of Rs 100, 000 and total credits of Rs 40, 000, the debit side is larger by Rs 60, 000. This difference is entered on the credit side as by balance carried down, making both totals equal. This Rs 60, 000 debit balance is then carried forward to the next period as to balance brought down. It is critical to distinguish between balancing and closing. Personal and real accounts, which represent assets and liabilities, are balanced. Their balances are carried forward because these items exist at the end of the period and will continue into the next. These balances form the basis of the balance sheet. In contrast, nominal accounts, representing incomes and expenses, are closed. Their balances are transferred to the profit and loss account to determine the net result for the period, and the accounts are reset to zero for the next year. This structured process, from transaction identification under IFRS or GAAP, through journaling in the books of original entry, to posting and finally balancing in the ledger, forms the robust and verifiable foundation of the entire accounting cycle. Each step is designed to ensure accuracy, enforce the discipline of the double entry system, and transform raw, chronological financial data into the structured, analytical intelligence required for strategic decision-making and transparent financial reporting.